Welcome back to the channel, everyone. We're diving into a question today that I think is on a lot of people's minds, especially if you're even a little bit interested in, the financial world. What really makes those stock prices jump around, up, down, sideways?
Yeah.
It can seem totally random sometimes, right?
It really can.
So we've got this research paper. It's called What Moves Stock Prices and How. Pretty straightforward title, but it gets into some really interesting stuff. I mean, we all know the economy plays a role, but this paper looks at things like politics, even like what time of year it is,
Right.
crazy stuff.
Yeah, that's one of the biggest misconceptions out there, that it's all totally rational. Like if a company does good, stock goes up. Simple. But the reality is human psychology, expectations, all that plays a huge part, which
Yeah.
is what makes this research so fascinating.
Okay, so let's start basic then. Economic growth, booming economy, should mean stocks are booming too, right? Makes sense to me.
Well, yeah, the connection's there, but it's not quite that straightforward. You see, stronger economic growth, a lot of times that means companies could be paying out higher dividends, right? And that gets investors excited.
Makes sense. More money for them.
Exactly. But here's the catch. That same growth, it can also make people worry about inflation. And inflation often leads to those interest rates going up, which can actually scare some investors off.
Ah, so it's like a two-sided coin kind of thing.
Yeah, you got it. It's not just about the growth itself, it's how everyone reacts to it, what they think it means down the line. There was this study back in 2006 by Rigabon and Sack, and they found that even when GDP jumped up way more than expected, stock prices barely budged.
Wow, so it really is all about those competing forces, like you said, canceling each other out.
Exactly. The market's always trying to guess the next move, not just react to what's happening right now.
It's almost like trying to predict the future, in a way.
And speaking of predicting the future, that's where something like industrial production comes in.
Okay, so we're not just talking about like factories making stuff, right? How does that number impact the whole market?
Well, see, high production, it's not just what's happening today. It gets people thinking, hey, these companies are doing well, probably going to keep making money, which makes their stock more attractive.
So future potential, that's the key.
Yep. There was this research by FAMA back in 1990 showing that a lot of times stock returns actually predict how much production is going to grow. Months, even a whole year later. Shows you how much the market's focused on what's coming, not just what is.
That's wild. Okay, so then what about interest rates? Everyone's always talking about those.
Yeah, interest rates. So, kind of like a seesaw, rates go up, stock prices often go down.
Why, though? This makes investors nervous about borrowing and stuff.
Part of it, sure. Higher rates make it pricier for companies to borrow money, right? That can hurt their profits, make the stock less appealing. But there's also the psychology of it. When interest rates are high, safer bets like bonds, they start looking better, less risky than stocks.
So it's like weighing your options, risk versus reward.
Exactly. Now, inflation. This one might throw you for a loop. You'd think prices going up would mean stocks go up too, right?
Yeah, seems logical. Keep up with the rising cost of everything else.
But often, it doesn't work that way. High inflation can actually mean lower stock prices, which seems kind of backwards.
Okay, now I'm confused. Why would that happen?
Few theories out there. One is high inflation can be a sign the economy's slowing down, which worries investors. Also, governments might step in with all sorts of measures to try and control inflation, but those can hurt businesses too, and thus the stock prices.
Ah, so it's like inflation is a warning sign, not a good sign.
Exactly. And there's even this idea of reverse causality. It's complicated, but basically maybe both inflation and falling stock prices are just symptoms of bigger economic problems.
So much to think about. Okay, so let's switch gears completely. Exchange rates, most people only think about those when they're traveling, right? Not exactly stock market stuff.
Right. But think about it, when our dollar is strong, we can buy more stuff overseas, right? Same idea applies to companies. Weak currency can actually help companies that export stuff because their goods become cheaper in other countries. But for companies importing a lot, it's the opposite. Suddenly their costs go way up.
Ah, makes sense. So big impact on some companies, depending on what they do.
Huge impact. Their whole business can be tied to how those currencies are fluctuating. And, this all points to a bigger idea. Stock prices, they're not just about how a company is doing right now. It's about what investors believe will happen in the future.
Yeah, that expectation piece is huge, isn't it?
It really is. And here's where it gets kind of crazy. Those expectations, they can become self-fulfilling prophecies. Like, if enough people think a company is going to do great, they buy the stock, price goes up. which can actually make that company do better. Easier to get loans, invest more, etc.
Oh, wow. So like a positive feedback loop. But I guess the opposite could happen too, right? Bad expectations driving the price down.
Absolutely. Negative spiral shows you how powerful this, like the feeling about a company can be. But here's the thing, markets aren't always perfectly rational. Like there are these weird calendar patterns, almost like times of year when stocks tend to move in a certain direction.
Wait, are you saying there's like a stock market calendar we should all be following?
Not a literal calendar, haha. But, for example, there's this thing called the January effect. Often stock prices go up at the beginning of the year.
Why January specifically?
Well, a lot of investors sell off some stocks in December for tax reasons. Then in January, they start buying again, pushing prices up.
So even taxes, something that seems so unrelated, can play a role?
Oh, absolutely. And different markets have their own quirks too. Like in India, there's a November effect. Prices go up around their big festival season, more money flowing around.
That's really interesting. So we've got economics, we've got psychology. What about politics? That always seems to get everyone riled up.
Oh, yeah. Politics is a big one. Businesses, investors, they hate uncertainty. And anytime there's some big political event, election, new laws, global stuff, it can really shake things up.
I can only imagine. So like if there's an election coming up and nobody knows who's going to win or what policies they'll enact, that makes investors nervous.
Exactly. Suddenly, the risk of investing in that market seems higher, so people might pull their money out, prices drop. There's a study, Kakani and Galki did it in 2006, found that in India, stock returns were consistently lower whenever their parliament was in session.
Wait, just because Parliament was meeting? Why?
Because it meant potential change. Even if no new laws were actually passed, the mere possibility of things changing was enough to spook investors.
Wow, so it's not even the actual event, it's the anticipation, the what if.
Yep. And this leads to another big factor nowadays, how connected all the financial markets are. What happens in one place can ripple out across the entire world.
Yeah, globalization and all that makes sense. But how does that actually work in the stock market?
Well, you've got these big institutions, pension funds, investment firms. They're putting money into markets all over the globe, always chasing the best returns. If they get spooked by something happening in, say, Europe, they might pull their money out of their A&D out of other places too, just to be safe.
So like a domino effect, one thing triggers another and another.
Right. And then a lot of companies, they're listed on multiple stock exchanges worldwide. So if their price drops in one place, it's probably going to drop in others too. Everything's linked up.
So to sum it all up, we've got economics, interest rates, inflation, exchange rates. We've got psychology, expectations, biases. We've got politics, global events. It's a lot.
It is a whole web of factors. Some you can try to analyze, some you just got to ride the wave on.
Makes you realize how much is actually outside our control, even with all the data and experts in the world.
That's the truth. And that's what makes it both fascinating and, well, a bit scary at times.
So we've talked a lot about like the big picture stuff, economics, politics, global trends. But there's another piece to this puzzle, right? The psychology of the investors themselves.
Oh, absolutely. You can have all the charts and numbers in the world. At the end of the day, is people making those buy and sell decisions. Their emotions, their biases, that's all baked into the market.
It's like a giant psychology experiment with real money on the line.
That's a great way to put it. And yeah, if you want to understand the market, you got to understand the people in the market.
So let's dive in then. What are some of those psychological traps that investors fall into? The things that can make them make bad decisions.
Well, one of the big ones is what we call herd behavior. Basically, people follow the crowd, even when it doesn't make sense.
Like everyone's buying this one hot stock, so you got to get in on it too, even if you don't really know why.
Exactly. Fear of missing out, FOMO, that's a powerful thing. They see others making money, and they jump in no matter the risk. Then, of course, the bubble bursts. Everyone rushes to sell, prices plummet, and a lot of people get burned.
Sounds kind of like a stampede. Haha.
Yeah, pretty much. And this herd mentality, it gets worse when you add in overconfidence.
Ah, yeah. We all think we're smarter than average,
Right.
especially when it comes to money.
Right. Investors, they often overestimate their ability to, pick the winners, time the market perfectly, that kind of thing. Leads to taking on too much risk, and when things inevitably go south, the losses can be huge.
So being aware of these biases, that's got to be step one, right?
Absolutely. Got to check yourself, make sure you're basing decisions on solid research, not just your gut or what everyone else is doing.
Okay, so we got herd behavior, overconfidence, Any other traps we should be watching out for?
Well, there's loss aversion. This one sneaks up on people.
Loss aversion. What's that?
It's like the pain of losing money, it hits us harder than the joy of making money. Like losing $100 feels worse than gaining $100 feels good, even though it's the same amount.
Yeah, I can see that. Nobody likes losing money. But how does that mess with people in the stock market specifically?
It makes people hold on to losing stocks way too long, like hoping they'll bounce back, even when all signs point to them going down further.
So they're so afraid of admitting they made a bad call, they just write it all the way down.
Yep, emotions taking over. Sometimes the best move, even though it hurts, is to cut your losses and move on.
Tough lesson, but important.
Hmm.
Okay, so what else? You mentioned another bias before.
Ah, right, anchoring bias. This one's sneaky too. Basically, we tend to fixate on the first piece of information we get about something, even if it's not relevant anymore.
So like, if I first heard about a stock when it was at, say, $50 a share, even if the company's totally changed since then, I'm still thinking about that $50 mark.
Exactly. Makes you hesitant to buy when it's higher or hesitant to sell when it's lower, all because of that initial anchor point.
Our brains are weird, man.
They are. And all this gets amplified by, the internet, social media. Everyone's an expert these days, giving advice, sharing tips.
Yeah, it's like information overload, but not all of it's good information.
Right. Got to be careful who you're listening to, make sure they actually know what they're talking about. And this isn't just for like everyday investors. Even the pros, the big institutions, hedge funds, they make mistakes too.
Wait, seriously? You'd think with all their resources, fancy algorithms.
Nope. Still human at the end of the day, subject to the same biases, same market uncertainties. Nobody's got a crystal ball, no matter how smart they think they are.
So how do these big players try to get an edge then? If they're not just relying on their gut, what are they doing?
Well, one popular approach is quantitative analysis, or quant for short. Basically, they use super complex math and computer models to try and spot patterns in the market, make predictions.
So like using the power of computers to try and beat the market.
Kinda, yeah. They crunch tons of data, looking for signals about which stocks are going to go up or down. Can be very effective, but...
But no guarantees, right?
Right. Market's always changing. Even the best model can get blindsided by something unexpected.
Okay, so quant is one approach. What else do they do?
There's also fundamental analysis. This is more about looking at the actual company, their financials, their management team, what industry they're in, trying to figure out their real value beyond just the stock price.
So less about charts and graphs, more about understanding the business itself.
Yeah, the goal is to find those hidden gems companies that are undervalued by the market but have huge potential.
Sounds like a lot of research, though.
It is. These big firms, they have whole teams of analysts digging into this stuff. They've got access to data. Most people don't. They meet with company leaders. It's a whole different level.
So they've definitely got an advantage in terms of information and expertise.
Oh, for sure. But again, they're not perfect. Still make mistakes. It's a reminder that in the stock market, risk is always there, no matter how much you know or how much money you have.
So diversification, long-term thinking. That's going to be key for anyone, right?
Absolutely.
Yeah.
And a willingness to learn, adapt, because this market, it never stands still.
Okay, so we've covered a ton of ground here.
Yeah.
The economics, the psychology, the global forces. It's a lot to wrap your head around. But there's one more thing we got to talk about, right? The ethics of it all.
Yeah, it's easy to get caught up in the numbers, the strategies, trying to make those profits. But we got to step back and think about, the bigger picture. How does all this affect, people, companies, the whole system?
Right, because the stock market, it's not just some game, right?
Yeah.
It has real-world consequences. So how do we balance making money with, doing the right thing? That seems tricky.
It is. One of the big issues is this tension between short-term profits and long-term value.
Makes sense. If everyone's just chasing quick wins, that can't be good for the long haul.
Exactly. It can lead to companies cutting corners, neglecting research, treating employees poorly, just to pump up those numbers in the short term, which ultimately hurts them in the long run and probably hurts the whole economy too.
So how do we encourage companies to think long-term,
Yeah.
Be profitable, but also responsible?
Well, regulations play a big role. We've got all these organizations, the SEC here in the U.S., the FCA over in the U.K. Their job is to keep an eye on things, make sure everyone's playing fair.
Right. Those are the folks who go after insider trading, fraud, all that bad stuff.
Exactly. And they also push for transparency, make sure companies are giving the public accurate information so investors can make smart decisions.
So it's like a safety net, in a way.
Mm-hmm.
Tries to prevent the worst abuses.
I
But
know.
then there's the debate about, like, how much regulation is too much,
Oh,
right?
for sure. Too much and you stifle innovation. Businesses can't move fast. Too little and you get chaos. People get taken advantage of. Finding that balance, it's a constant struggle for governments.
Yeah. Sounds like a tough job. But at the end of the day, even with the best rules in place, it still comes down to people making ethical choices, right?
Absolutely. Companies got to build that culture of doing the right thing, not just because it's good PR, but because it's good business in the long run.
Yeah, consumers are getting smarter about this stuff. They
Okay.
want to support businesses that align with their values, right?
Big time. It's not just about profits anymore. It's about impact. What's your environmental footprint? How do you treat your workers, your community?
So this whole idea of, like, ethical investing, it's actually gaining steam now.
Huge momentum. People want to put their money where their mouth is, support companies that are trying to do good in the world.
That's really encouraging to hear. Shows that maybe, just maybe, we can have it both ways, profit and purpose.
I think so. The stock market, yeah, it can be this crazy, confusing beast sometimes, but it can also be a force for good. It can drive innovation, create jobs, help build a better future.
That's a great note to end on. Thanks so much for breaking all this down for us. I know I learned a lot.
My pleasure. Always happy to chat about this stuff.
And to all of you listening, thanks for joining us on this deep dive. If you enjoyed it, be sure to like and subscribe for more. We'll see you next time.